Thanks, Dave, for joining our quarterly webinar. Let's start out by discussing the state of the U.S. economy in the absence of that long-awaited recession. What is your reaction to the strength of the U.S. economy so far this year, and how do you see the rest of the year playing out?
Thanks, Joe. You're correct that the economy has demonstrated continued resilience in the face of the doom and gloom predicted by most economists at the beginning of the year. So let's start by revisiting what economists predicted for U.S. growth just 6 months ago. The chart on the left shows how economists' prediction for the U.S. economic growth in 23 evolved over the last year. At the beginning of 2022, the more than 60 economists surveyed by the Wall Street Journal thought the U.S. economy would continue to show real economic growth at better than 2% coming into 2023. But then inflation continued to climb, peaking at over 9% in June, and the Federal Reserve turned more aggressive in raising interest rates to fight inflation. So as a result, economists' expectations deteriorated. At the beginning of this year, those same economists believed that the U.S. real economic growth would only be plus 0.2%. The table on the right breaks down their 2023 forecasts for each quarter. In January, economists predicted that the economy would be essentially flat, yet the U.S. economy continued to grow at 2%. For the second quarter, they initially thought GDP would be negative and then changed their growth forecast to 0.1%. However, it looks like once again, the economy may have grown by 2%.
So Dave, why did they get it so wrong?
I think it's fair to say, Joe, that few thought consumer spending would remain as strong as it has. Let's look at what makes up the U.S. economy and how each component contributed to first quarter growth. On the left, we see that consumer spending, officially called personal consumption expenditures, accounted for 68% of the U.S. economy in the first quarter. Government spending accounted for just under 18%. Business investment made up 17%, but then we have to subtract 3% because we import more than we export.
So wait a minute, on the net imports topic, so why do we have to subtract net imports?
Because, Joe, GDP measures the values of goods and services consumed in the United States economy. Anything that we consume made outside the United States is included in the GDP of countries we bought it from. Now, we do include the value of exports, but the U.S. has long imported more than it exports.
All right, that makes sense.
So if we look at the chart on the right, consumer spending grew 2.8% during the first quarter. About half of that came from durable goods purchases. The auto industry experienced better than expected sales during the first half of the year, largely because of pent-up demand for new cars resulting from the shortages that came out of the pandemic. Consumers also spent more than expected on furniture and recreational goods, such as boats and all-terrain vehicles. This was somewhat unexpected given the rise in interest rates. The other half was growth in services such as airline fares, hotels, and restaurants. We did see a noticeable decline in business investment, which really isn't surprising as it was a response to the forecast from economists that there was going to be a recession.
So Dave, you said in the second quarter, growth is also going to come in at 2%. Can we assume that consumer spending is the main contributor?
From the forecast I've seen show, consumer spending was not as strong in the second quarter as it was in the first, but there appears to be positive growth in business investment, again in response to stronger than expected consumer spending, as well as a buildup in inventories.
So Dave, what about the rest of the year? Are we finally going to see that recession?
It's hard to say, Joe. As we see on the left side of this next chart, consumer confidence has bounced off of its low from a year ago, but it's still meaningfully lower than it was pre-pandemic. So while not a level that we would like to see, consumer confidence does seem to be improving. But if we look at the right side, purchasing managers for manufacturing companies continue to paint a pretty bleak picture. with 56% of respondents saying that business conditions at the end of June were worse than the month before. Now, conditions for the service sector are positive. So, as you said at the beginning of your earlier remarks, Joe, it's a mixed bag. But ultimately, we must pay close attention to Chair Powell and the Federal Reserve. They've been quite emphatic in their position that inflation remains too high relative to the 2% target. True, headline CPI has come down from over 9% to 3% at the end of June. However, the Fed's preferred measure, known as the Core Personal Consumption Expenditures Price Index, remains elevated at 4.6% for the month ending in May, as you can see in the chart on the right. And as you stated earlier, Joe, 2 more rate hikes this year are certainly a possibility. Hence, I believe that we are in the cusp of an economic slowdown. I can't say that a severe recession is inevitable, but there are several signs pointing to a decline in consumer spending. We've seen consumer savings rates increase, and we've also seen high consumer credit default rates. In addition, the student loan holiday will be ending in September, and that will certainly put a dent into spending.
So what does that mean for the markets, Dave? Has the market gotten ahead of its skis in the first half of the year?
I would not go that far, Joe. Everything I've said up to this point is widely known, and I believe reflected in current market prices. Let's not forget, the market began anticipating a recession in 2022. And despite the performance in the market so far this year, we still have not made up for the losses in 2022. So let's first look at this next chart. It displays some of the same data you showed earlier. The S&P 500 was up nearly 17% in the first half of the year, though heavily skewed by the artificial intelligence technology stocks that you mentioned earlier. Some of us have referred to this group of stocks as the Super 7. Collectively, they gained nearly 61%, meaning that the rest of the U.S. stock market only gained about 6%. Developed country stocks performed quite well, up nearly 12%, while emerging market stocks gained about 5%. But now look what happens when we look at the next chart, when we combine returns in the first half of the year with 2022 returns. All markets remain underwater compared to how they ended 2021.
That's a really interesting point, Dave. But what about corporate profits? Aren't they still in the proverbial tank?
That's a good point, Joe. Yes, the outlook for near-term corporate profits is rather anemic. Profits declined in the fourth quarter of 2022 and just barely achieved growth in the first quarter of this year. And the outlook for the second quarter is for a profit decline of about 6%. Expectations for the third quarter aren't all that rosy either. But again, the markets know all this. Stock prices very likely reflect a poor corporate profit outlook and the potential for a near-term recession. Future gains or losses in stocks will depend on how severe and how long the market ultimately expects the recession will last. So back to your original question, Joe. No, I don't believe the market has gotten ahead of its skis.
So let's pause here and talk about what's driven prices for the Super 7 that you mentioned. You've been a big fan of ChatGPT. I've also integrated it into my arsenal of professional tools, use it as a brainstorming tool as well. Research shows that artificial intelligence, or AI, right now is a $100 billion industry that could grow to $2 trillion plus by 2030. Is AI the phenomenon that we're hearing about, or a passing fad, or a game changer?
I definitely think it's a game changer, Joe. And I think so in a big way. Just like the internet was 25 years ago. I think all of us that were using the internet thought it would be life-changing, but we just couldn't quite imagine exactly how. Now, fast forward to 2023, and no question that the internet has drastically changed our day-to-day lives. from how we get our news, to how we shop, to how we are entertained, to how we interact with others. Life isn't the same as it was 25 years ago. Now, while I can't today say exactly how AI will change our lives, I do believe that 25 years from now, we are going to have experienced another major life-changing transformation. This chart showing now touches on some of the applications that we can expect AI to deliver in the future. I sure saved a lot of time identifying the applications for AI in this slide. I simply asked ChatGPT to identify practical AI applications, and what appears is the response I received from the chatbot. Now, we prepared the slide, but I can imagine a few years from now, I could just say, create a PowerPoint slide with 10 AI applications, and I would have had the same slide pop up.
So I agree, Dave. And AI is in its infancy in many ways. It's certainly going to be interesting to see how this technology continues to develop and integrate into our lives. So finally, what do you see in international markets? As we both discussed, the developed markets turned in some decent performance in the first quarter. While the emerging markets were positive, they continue to lag the US and developed markets. How have the international markets performed this year, and what are your thoughts about international economies for the rest of the year and in 2024?
Well, Joe, so far this year, the international markets have been, well, a mixed bag. Developed stock markets in France, Germany, Holland, Italy, Japan, and Ireland all produced double-digit returns, with half the countries that I mentioned beating the US stock market returns. In emerging markets, Latin America produced strong returns, though a significant portion of the return is due to strength in Latin American currencies relative to the US dollar. Latin American central banks have aggressively pushed up rates to fight inflation, which has positively influenced currency flows to those countries. However, China continues to disappoint. Expectations were high going into 2023 due to a lifting of the COVID restrictions. Last week, Bloomberg reported that China is facing a continuation of its problems: sluggish consumer spending, a crisis-ridden property market, declining exports, record youth unemployment, and elevated levels of local government debt.
So let's pause a second here, Dave, because China is a topic that we frequently discuss with clients. The Chinese market, and to an extent its economy, have been in the doldrums for the past several years. And as you said, the economy is facing several economic headwinds. Add to that concerns about human rights violations in China and an invasion potentially of Taiwan. How confident are you that China remains a viable source of investment returns in the future?
So those are all good points, Joe. Chinese stocks have not produced anywhere near satisfactory results over the past several years. We do maintain frequent contact with our asset managers that invest in Chinese stocks, and they collectively maintain high conviction regarding the specific companies that they hold in their portfolios. Now, I should mention that Chinese stock valuations on both a price earnings and a dividend yield basis are really quite attractive. So, Joe, I'm still not ready to throw in the towel yet on China.
Okay, Dave, understood. So what is the outlook for the remainder of the year?
So Europe and especially the UK continue to struggle with inflation, and their central banks remain steadfast in aggressively administering monetary policies to bring inflation down. Hence, the situation in Europe is like the US, with many waiting for what they believe is that inevitable recession. So let's take a look at the purchasing manager surveys for Europe and the emerging countries. As you can see, current conditions in Europe are like the US, and the worst they've been over the past year and a half. Conditions are a bit better among emerging countries, with India being a strong standout. As we see on this next chart, and once again, like the US, services seem to be in a fairly decent shape, except for possibly France, which has been affected by domestic unrest over the past week or so. So to summarize, the rest of the world seems to be in a state like the US, waiting nervously to see how deep and how long the inevitable recession is going to last.
Great, thanks, Dave. It's certainly going to be interesting to see how the U.S. and the world economies evolve over the next several months.
Thanks, Joe. And once again, I've enjoyed sharing my thoughts with our viewers.